Today, I'm kind of excited. So, Michael Howell hasn't done a public interview in a while, and he just did one on the 28th. It looks like today it was published, I think, for yesterday. In it, he's going to be talking about global liquidity and his thoughts on it and what's coming next for markets and a weakening dollar and just a bunch of topics that I think are really fascinating and I wanted to share with the group. So, without further ado, we will be jumping into the interview. And then what I will do, as usual, is I will kind of interject as we go along. I'm going to try not to do that too much in this one because he has a lot to say. But I'll try and jump in where I believe it might be needed. And if you guys have questions in the chat about what's being said, please let me know. I'll try and answer them to the best of my ability. I should think this should be really enlightening. This is the whole reason I made 7X. I've been saying 700%, but it's not right. 7X last year in 2023 or 600%. So I've been saying that wrong number, so sue me on that. Anyway, markets bleeding today. Yes, I wouldn't say bleeding. They're definitely taking a hit ahead of NVIDIA earnings because people are afraid that they're not going to amount to all the hype. I think they will, but it should be very interesting. Yeah, if you guys could hit the like. Let's get started, though. I want to go ahead and hear what Michael has to say.
The fact is that the most bullish time for markets is when you've got a slow economy or sluggish economy that policymakers are trying to goose, and that's exactly what we've got. And you've already got a background in global markets now, where number one, you've got a soft US economy, not a recessionary economy. Number two, you've got a Federal Reserve that wants to ease now, which is clearly a big tick. And the third thing is you've got deflation in China. So that's keeping a lid on inflation pressures worldwide over coming.
I have been saying that. I just got to interject. Sorry, I'm doing it already. I've been saying this forever, that China will export deflation to the rest of the world and that will get inflation under control, which potentially will allow for more money printing and stimulus and or just easing ahead of time here in the States, and that it could end up saving us from a financial meltdown. And I still think that's the thesis right now. Dougie Fresh is 80% cash. Root for Dougie Fresh, guys. Hopefully he's going to be right and he'll make all the money and we'll look foolish. But let's go ahead. Let's get back to it.
Months. So this is really a pretty good environment for financial markets generally. We're still risk on. We continue to be risk on. Nothing we've seen over the last few weeks or months has really dented the uptrend in global liquidity.
This episode is sponsored by Mantra. The Mantra chain is the purpose-built layer 1 blockchain designed for tokenized real. We're recording this on Monday, August 26th, just off the back of Howell's speech at Jackson Hole on Friday, where, by most regards,
I guess we'll see soon enough, Dougie Fresh. I definitely won't dunk on you if you're wrong, but we'll see soon enough whether or not your thesis plays out.
It was a pretty dovish inflection point in terms of how he's starting to view.
I will say this, though. People said that same thing about NVIDIA last quarter, and I think the quarter before. So we'll see.
The rate cutting cycle that looks to be starting in September. I just want to start with getting your initial reaction on what you heard in that speech and its implications on how you view global macro.
Well, I think the first thing to say is it sort of represents a secular change in US monetary policy. It's pretty clear that there's going to be rate cuts coming. I think the maybe surprising thing that Powell said was that there is going to be a rate cut. I mean, I thought that was an FOMC decision, not his decision, but he's pretty much foreshadowing that. And what's more, inflation seemingly is beaten. That's what he told us. Employment is now more of a target for the Fed, more of a concern. So that really enables them to cut rates potentially quite aggressively over the course of the next few months. And I think that the other thing that comes out of this is there doesn't seem to be any great concern about the level of the dollar. So the US currency can fall further from here.
I'm going to drop my image here.
A heads up to generally more liquidity and more global liquidity in the world economy. And that's really what matters fundamentally in our view for markets. More liquidity means asset prices go up.
Totally. It seems like, the interesting dynamic, and you just mentioned, is this major tilt from the focus on inflation to now we have this. It almost felt like there's this Fed put that was struck under the labor market. He had discussed how they don't welcome any further, loosening in the labor market. And it seems like as if there were to occur, higher unemployment rate or something like that, they would be matched with easing. Is that how you see it as well? And how does that land into your view of whether we're going to be going into a recession or this is more just a growth scare that may rebound?
As you say, I mean, there is the focus now on employment. They said they didn't want any more slack in the labour markets. Enough is enough. So I think that's a pretty good heads up. I think the fact is that the most bullish time for markets is when you've got a slow economy or sluggish economy that policymakers are trying to goose, and that's exactly what we've got. And you've already got a background in global markets now, where number one, you've got a soft US economy, not a recessionary economy. I'd stress. All the evidence we see is there's no odds of, or low odds of recession out there, but there is definitely a slow economy going on. You've got that number one. You've got number two. You've got a
Yeah, I 100% agree with that. I just want to hold there for a second. I 100% agree with that because I think the reduction of rates will open up the housing market. And again, the potential of a presidency that's pro-capitalism, that's going to deregulate, that's going to make it easier to make profits, that's going to be business friendly, that's going to help the bottom line and margins. If that proves to be true, then I think markets do really well over the short term heading into the election and after the election. And if we look at even Bitcoin, the year after elections, it just skyrockets. And that also is because of, again, just money printing. No matter which candidate you like, they're going to print money, tons of it. So his thesis still holds, in my opinion.
Federal Reserve that wants to ease now, which is clearly a big tick. And the third thing is you've got deflation in China. So that's keeping a lid on inflation pressures worldwide over coming months. And, although I must admit, I'm not that optimistic about inflation, secular inflation. I think the trend is going to be higher than the Federal Reserve's target of 2%. But, one's got to accept the fact that maybe that target of 2% will be beaten on the downside in the next few months because of deflation coming out of China.
Okay, I was just going to argue against what he was saying, but it sounds like we're going to the same place. He believes that the inflation target won't be 2%, that it might be closer to 3. I won't argue that at all. I think that's actually a pretty decent likelihood. It's kind of arbitrary to act like 2% is the right number versus 3. I don't know that there's any hard science at all indicating either way.
So this is really a pretty good environment for financial markets generally. We're still risk on. We continue to be risk on. Nothing we've seen over the last few weeks or months has really dented the uptrend in global liquidity. And if you want to look at some charts, I mean, you can see. I think on the chart deck that I've got, the first chart that you can see there is our global liquidity cycle. Now, I've cheated a little bit in this chart that this is just the advanced economy.
Pay attention to these charts. I'm actually probably going to expand a little bit. These are great. These are incredibly valuable. People usually pay for this kind of stuff. He's going to go through his entire list.
So China has been taken out. The reason that China's taken out is that China has been pretty turbulent in terms of its liquidity withdrawals and injections over the last few months. And so it does distort the general trend. But you can see here that global liquidity shown in black, which is our index of liquidity injections across 90 economies worldwide. I mean, that's obviously weighted by size. So the US is a lot more important than others, but nonetheless, it's a comprehensive measure. That cycle bottomed around October of 2022. We've been saying since then, and it's likely to peak out probably in late 2025. You can see the sine wave that we put on top of that. And just to stress the fact that we haven't been cheating here, that sine wave was first drawn up in year 2000 based on the history from 1970 to 2000.
Did you hear that? That sine wave that he has in here, this pattern, was done in 2000. So it's been around for 24 years, and it's proving to be very accurate over that time frame. Even more so, honestly, than historical.
It's been extrapolated, from 2000, but it seems to be matching. The actual cycle seems to be matching that sine wave. So what you've got is an upturn that's still coming. So I think that's clearly a positive. What went on in markets in the last 2 or 3 weeks, concerning the yen carry trade or the unwind, was much more a change in risky exposure. It was nothing about to do with the underlying trend in liquidity. And in fact, if you look at the next slide, you'll see there that on that slide, it basically shows the other dimension that we monitor. So for us, financial markets are driven by 2 moving parts. One is the flow of liquidity into markets, the flow of global liquidity. And the second of those is the risk positioning of investors, how they deploy that cash that's coming in. And that is shown with the orange line on that chart. 0 is a normal asset allocation. And normal means a rolling 5-year average. The black line is the business cycle worldwide. So it's a comprehensive measure of all business surveys taken across the globe. So things like the Tankan in Japan, the US ISM, the PMI survey, that is, the UK CPI survey, all these things aggregated together. So the black line is the tempo of the world economy. The orange line is risk positioning of investors in markets. In other words, how much risk assets, equities, corporate debt have they got in their portfolios relative to a norm. And you can see that the orange line.
So again, this explains a lot about what we're looking at, especially with the investments I'm in right now, because we can see the business climate is very, very positioned towards downside movement and contrasting, right? Because like they're sitting in the 40 level, which is negative territory. And then at the same time, we're seeing risk exposure. So we're seeing that the holdings are really low, and we're seeing that people's willingness to jump towards risk-related investments is still very, very low. So his thesis is that this is getting ready to take off, but it hasn't yet. And I think that is mine as well.
And the black line pretty much overlap most of the time. except when they don't. And what you saw in sort of early August was an adjustment that may well have been triggered by announcements in Japan, but it was really a risk event. In other words, people pared down the risk exposure of their portfolios. It wasn't an interruption in global liquidity, which we saw from that earlier chart.
So Japan carry trade, it wasn't a reduction in liquidity. It was just people taking risk off the table. So if anything, we're even safer now than we were before.
And the liquidity is still going up. And that's what I think will happen. So if you say, what is the outlook for markets going forward? If you believe, as we do, that the world economy is in the process of bottoming out, therefore you've got to expect that black line to move higher in coming months. That would support the orange line, so risk exposure can go up. In fact, as we know, it's gone up anyway in the last 2 weeks following that initial sell-off at the beginning of August. You've got more risk exposure, you've got rising liquidity. What's not to like?
You know, when I think a bit about your framework as you've been tracking this throughout the year, it seems like one of the last, maybe shoes to drop in terms of global liquidity heading higher was this, fundamental shift in the easing cycle from the US. It seemed like that was sort of the last component to shift. And are you seeing now that with that shift, we will likely see this next leg higher in the liquidity cycle at the same time that, we'll see what happens on the Bank of Japan if they continue to hike or not. But aside from that, if they just pause, it seems like for the most part, most global central banks are coordinated in starting their easing cycle now. Is that being reflected in what we might see heading higher next in that liquidity cycle?
Yeah, I think absolutely. I think what you've got is you've got two things to take into account. I mean, number one is there's a chart, I think, a few further on, which is looking at a heat map of central banks. What that shows is a heat map of central bank activity. And the way that you read that is pretty simple. Red is tightening. Yellow, orange is kind of neutral, green is easing. And what you've got is this shift over time from this sort of peak tightening period, which was around the summer of 22. And increasingly, as you move from left to right, the timeline moves towards the current. And you see the hues in the chart shift from red, orange towards the more benign end of the spectrum, the sort of the yellows and greens. And that's showing that basically central banks, which are all listed down that left-hand axis, it's pretty minute, but this is about 90 central banks, are showing that more and more central banks by number are actually easing. And that's, a key thing to watch. Now, that's number one. So there is an urgency or a need to ease because economies are weak. And as I said, the best time for markets is when you've got slow economies that central banks are trying to stimulate. But the other thing that may be going on here is really the currency markets. And I alluded to the fact that, what Jay Powell has been saying is certainly not dollar supportive, rather the opposite. And one of the interesting extrapolations is to say, are we in a situation which looks a little bit like the mid-1980s and the Plaza Accord in 1985? Now, the reason that I cite that was a period where we had a lot of dollar strength. The US economy was coming off a period of tight monetary policy and loose fiscal policy, pretty much like we've got today. The dollar was empowered by that, but then there was a desire to get the dollar down because it was squeezing the world economy, it was affecting global liquidity, it was adversely affecting other countries. And other countries really wanted to ease. Now, what you saw at the time was a concerted attempt, an accord to get the dollar lower, which basically was the Fed easing quite a lot. And if you, there's a slide I can show you, which is actually looking at this in a modern context. That, by the way, that chart is not the one, but it's actually an interesting one to look at because if you look back, what that shows is another way of understanding that we've got easing going on. This comes from the senior loan officer.
And in here, he's saying net percentage of global banks tightening has been coming down since 2023. So if banks aren't tightening, they're easing.
Opinion surveys taken across the world, not just the US Fed survey, but this is surveys from Europe and from Japan. And it shows the net percentage of global banks, this is high street banks, commercial banks, that are tightening. Now, if you look at that chart, you can see there that the percentage tightening in this side.
High street generally means something like retail, in consumer. That's what high street banking means.
Michael peaked probably in 2023 at about 30% net. And you can see it's falling, and that is going to fall into positive territory. The chart is flipped over. So basically what you're reading there is that if it's a negative, that's saying that there's actually a net percentage easing.
Real quickly, Needs 55 said, Jesse, what are some of your signs when the top S wave is reached? There's going to be a bunch of those. There'll be some of those in the Bitcoin world. There'll be some of those across all kinds of economic data. There'll be a lot of that coming from my boy Michael Howell from CrossBorder Capital as well. So there'll be a bunch of signs that we're reaching near the top. There'll also be technical signs in different indices indicating like extremely overbought conditions, probably on at least the weekly time frame, if not the monthly. It'll be a lot. There'll be a lot of stuff we can look at.
By definition. And that's clearly bullish for liquidity too. But to come back to the point about currencies, if you flip on a couple of pages, you'll see in that you'll see a bit further on. So this is looking at something that I've called the Asian euro, and I think that's slightly unfair on Asian currencies to be dual euro, but notwithstanding, it serves a purpose. And this is a basket weighted by importance of all the Asian currencies. So it includes the Japanese yen, it includes the Taiwanese dollar, it includes the Hong Kong dollar, the Chinese yuan, the Australian dollar, the Indian rupee. So it's a pretty wide basket. And what it shows is movements really since the mid-1980s. And you can see at the beginning of that period, the Plaza Accord and the so-called Endaka period, which was a strong yen. And then you can see the gyrations really moving around ever since. Now, what I want to focus on is the latter period, and particularly the period that I call the Shanghai Accord. Now, the Shanghai Accord, as you probably recall, was a sort of tacit agreement that was not well publicized at the time. A lot of the media have since written about this. It was a G20 meeting. I'll go to the G20 meeting in Shanghai, where there seemed to be a deliberate attempt to actually control Asian currencies or stabilize Asian currencies against the then strong dollar. And what that principally meant was whenever the dollar got stronger, these currencies tightened monetary policy to basically keep the Asian unit within that band or that Asian basket. And that was really centered around, at least I would say, it was centered around the Chinese yuan, which was critical in that whole equation. Now, if you look at that period of Asian currencies, it was remarkably stable. I mean, a period that I've never seen that sort of stability in Asian markets before. And it was stable until it wasn't. And it wasn't stable, basically, as we moved into 2022. Now, two things happened at that time. Number one was the Russians invaded Ukraine. And number two, in pretty short measure, the yen collapsed. Now, that collapse in the yen in the spring of 2022 was the fastest move downwards I've ever seen, and the biggest move downwards I've ever seen in a G7 currency, in a major currency unit. I don't think markets can ever do that to currencies. I don't think only governments do. So in my view, the yen was weaponized during that time, and it was focused on China and destabilizing China, or if you like, holding China's feet to the fire.
All right, that's fascinating because I've had that same thesis for a while, and that's kind of what the Biden administration has been trying to do too, with China, is holding their feet to the fire, applying pressure on them, letting them know who's the boss while we're still the boss. So it's fascinating to hear him say this exact same thing. I haven't heard that before.
And it put a lot of pressure on China, and China basically had to tighten monetary policy quite significantly. This is why the Chinese economy has found it really difficult to recover from the COVID lockdowns. It's never really got going. It's spluttered and stuttered ever since. And that was because of this tightness in monetary policy. Now, what I've labeled, correctly or incorrectly, and this could be, I could be miles off on this thesis, but all I was saying was, if you look at what's happening now in Asian units, they seem to be stabilizing. And maybe what we've got, what you could loosely call a Shanghai Accord 2. Now, there hasn't been a meeting in Shanghai, but maybe.
I agree with that. We're actually seeing pressure coming off the yuan and the yen, more so off the yen, but it does seem like there's been massive stabilization there. So that's fascinating.
There's been some agreement between America.
And again, we don't know what's all been done. We don't know if there's swap lines. We don't know all the details behind the inner workings. I'm sure the Fed and the Treasury definitely don't want to make it all apparent. They want some like fugazi. They want to be hidden a little bit by what's actually going on. But it's fascinating how the market's completely stabilized after the carry trade, and everybody was worried that the entire world was going to fall apart a couple of weeks ago.
America, Japan, and China, there's a quid pro quo. I don't know what that means. It may be something to do with buying treasuries. It may be something to do with support, for Ukraine against the Russians. I don't know, but maybe something's done. And what you're now seeing is stabilization in Asian currencies. Now, the importance of that is that may be rather similar to the original Plaza Accord in 85, that it involves US easing, a lot of US easing. Asian currencies have stabilized in that period. We're now seeing the yen move into a different trading range. And you look at the Chinese yuan, it's trading at some of its strongest levels this year. So it's would seem as as I say, if it's yellow and quacks, it's a duck. So it looks like it is a duck in this case. And what does that mean for global liquidity? It means what you're going to get is probably quite a significant boost in liquidity. If you look at the next slide, this is the period of Plaza Accord. The orange line is the current liquidity cycle. This is shown as an index between 0 and 100. So anything over 50 is net ease or significant net ease. And the red line is the period from 1981 to 1989. So we're looking at the 2019 to 27 period laid on top. Now, if this is correct, what you're seeing is an upswing in global liquidity. And I would say that, the equivalent of this Plaza Accord deal, when the US eased and then ultimately others joined in. So the Japanese joined in, the Germans joined in following the Plaza Accord once the US had made the initial move.
In case you're just getting this right now, Michael Howell is brilliant when it comes to global liquidity, currency markets around the world, how the Fed and Treasury and other central bankers communicate, work together, how the bond market works. This man is a sage. Definitely somebody you should spend time with, and I think just absolutely brilliant. And I love what he's done here, where he's showing the overlay between 1981 and 1989, and he thinks that that's going to be the projection for 2019 to 2027. Roughly. Very fascinating stuff.
Move. You're likely to see the same thing, but it's a Shanghai Accord 2, if you like. It may not be the same scale as Plaza Accord, but I think it's significant. Now, the Plaza Accord, if anyone remembers that period, ended sort of tragically, if you like, with the '87 stock market crash. But in between that, you had a Louvre Accord in February of '87, which then tried to support by tightening policy a then weak dollar. So the dollar had been kicked down the stairs at the time of the Plaza Accord, and it went into free fall, and the devaluation was just too much for people to stomach.
And I don't know if that can happen this time. I don't think the dollar can weaken that much. I just don't. I think it's needed. It's needed for trade in a massive way right now. You can see as the European euro falls apart, that the dollar is only gaining strength, and it's at some of the highest percentage of trade that has ever been in history. So I don't know. I think there's going to be still a massive demand for dollars because of the fact that we're the cleanest shirt in the dirty laundry right now.
So the US basically had to
and the world reserve currency
tighten, and that foreshadowed the '87 crash. So watch the dollar carefully. I don't think you're going to get a big collapse in the dollar, but I think you are going to get the DXY testing probably 95, and that's what we've been suggesting.
That's more bearish than I expect. I'll be fascinated to see if he's right on here, and he's going to give some of his reasoning.
It's already down from 106 to under 101, so it's testing now 100. So we'll see what happens. But this is significant because a weaker dollar means more global liquidity.
Mm-hmm. That makes sense to me. I love the way that we frame this up, actually, by looking at the composition of global central banks that are tightening versus loosening, because for those that aren't in the weeds of FX, a lot of the price action and change in prices of currencies is related to rate differentials, implied rate differentials, and where they're headed in terms of this bifurcation in rates. So, a lot of what we've been seeing is the reason, the yen has started to rally so significantly over the past month or so is because the Bank of Japan hiked for the first time in many, many years at the same time that Powell is finally shifting gears and looking towards loosening. So that has implication on currencies. This episode is sponsored by Mantra, the Mantra chain built with the Cosmos. I want to ask you a little bit about this idea of, this quid pro quo, this agreement that potentially occurred between the US and either Japan or the other Asian currency markets in terms of the mechanics of how that actually happens. Because while I was looking at what was going on over the past few weeks with the yen, I was looking pretty closely at something like Fed swap lines and if there's any activity there. And, there was pretty much nothing really happening. There was no execution of, Federal Reserve swap lines between the Bank of Japan and the Federal Reserve. But, if we just look at the price action of currencies, it's quite clear, as you're saying, something happened. Even though, today the yen is starting to rally again and is testing those levels once again, there's not quite the same strain on markets. So I just want to ask, what do you think is those mechanics that occur that actually creates it? Is it just, central bank easing differentials and becoming more coordinated, or is there something more specific? And why don't you really see that in things like swap line activity?
It's a great question. I cannot answer that. Probably it's a hard one. What I would say is that if you look at yen dollar, it's the most illiquid of the major crosses, and it's the one that is easiest for the Bank of Japan to control because it basically will have sway over major Japanese institutions, and it can tell them, you either switch out of dollars or switch into dollars, whatever it may be, so they can control the flow. So I think there's a lot more potential for the US authorities and the Japanese authorities jointly to control the yen dollar cross more easily than any other cross.
That makes sense. And so, like I was saying, the yen has started to strengthen again, but it doesn't seem like we're seeing that same strain in markets right now. What do you think that is? Is just like the over-leveraged players are already carried out, and everybody else is sort of less leveraged and not getting liquidated or having the VAR de-risk or something like that?
Yeah, it's. I mean, in a way, it's a surprise because I would have thought, given the scale of the move and whatever, we know volatility hurts traders, so. I'm surprised that more dead bodies haven't surfaced, but the fact is that they haven't. Probably tells us that the yen carry trade was not that big anyway. I mean, our estimates would put it at about $500 to $600 billion, and probably in reality, something like 2/3 may well have been closed during this period. So it could have been meaningful.
So yeah, he's saying $500 to $700 billion, and that 2/3 of it could have been closed. And I was seeing numbers that from people that were insane of like 12, 15, 17 trillion dollars in the Japanese carry trade, which didn't make any sense at all. And people like Lynn Alden were mocking. So again, it might not have been nearly as big as people thought.
But maybe those. I mean, what it may be telling us that even those estimates, those low estimates, were too high.
Okay, so we have a global coordinated easing cycle beginning now. Liquidity is heading higher. There's this volatility control of currencies. I want to talk a little bit about the implications on the bond market over the next little while. What is your perspective on the long end throughout this? And I also want to pair it to something that I haven't heard a lot of people talk about is we're going to be going into the first rate cutting cycle where QT is still ongoing, assuming that's the case. Is there any specific concerns or insights you have there in terms of what that might look like and how that starts to reflect into your perspective on the bond market as it stands?
Yeah, I think the first thing to say is that QT, as defined by the Fed and by the Treasury, is basically reductions in the size of the Federal Reserve balance sheet. Whereas when they spoke about QE, they were talking about liquidity, and the two things are very different. The balance sheet can shrink and liquidity can increase. And that's, after all, what we've seen over the last 18 months. Fed liquidity, which is something that we used to look at very pretty closely at Salomon Brothers, and I wrote about in the book I published a few years ago called Capital Wars. Fed liquidity is the liquidity creating parts of the Fed balance sheet. And that has been increasing, even though the overall balance sheet headline number has been coming down over recent months or the past 12, 18 months. So that's pretty clear. The balance sheet can continue to come down, and liquidity could go up. So let's be clear about that. Now, I think in terms of the bond market, I think there's an awful lot going on in the bond market that we ought to address. And I can show you some slides, and this may get into the weeds and maybe slightly wonkish, but let me try and do that. Now, let me begin on this one. Now, one of the things that we've been arguing over the last 2 or 3 years is that what Janet is doing at the Treasury is active duration management of Treasury issuance.
This is a great part. This is where he's going to talk to the fact that they're not issuing a lot of long-term dated bonds right now. Instead, they're trying to finance the U.S. government with shorter dated T-bills or Treasury bills. It's basically like a bond, but it's for a short period of time. And they're doing that so that they're not locked into long 10, 20, 30-year agreements to pay really high rates for that debt. So they're basically expanding the amount of T-bills or Treasury bills, these shorter dated securities, so that they're only locked into a 5% interest rate for a very short period of time. So that's how they're doing their debt management. It's actually pretty brilliant and working so far. But you can see it on the chart here. If you see the increases from 2022-ish to 2023 and how much it's expanded for T-bill issuance, that's a good sign that he's right.
Or, if you like, the US issuance calendar. And this is showing the percentage of Treasury bills outstanding in total US public debt. Now, you can see that there's a grey area which is shaded there. And that is the grey area that one has been led to understand, and the TPAC Advisory Committee for Fed issuance pretty much pays homage to this, that Treasury bill issuance should be between 15 and 20% of total debt. And you can see that it varies quite a lot. It's been
I see what he's talking about. Right here, it's slightly discolored between the 20% and the 15% mark. And they're saying that it should be like under this or close to this level and not exceed it. But you can see where during the pandemic it did. You can see where more recently here it has. And you can see where in 2008 during the great financial crisis, they did the same kind of thing where they issued a bunch of Treasury bills. Although this is much more contained.
Radically higher, such as in 2008, and it's been a lot lower as in 2016. But generally speaking, you're in that band. And I would suggest that we're about to break, we have broken out of that band, but I think we're going to go higher, probably testing 25%. Now, why is that important? That is important in two regards. The first thing to say is who buys Treasury bills? And who buys Treasury bills? And let me just, maybe I've got to say here, what is a Treasury bill? Treasury bill is basically a non-coupon paying US government instrument that has a maturity up to 1 year. So it's issued at a price and it matures at par. So, it will
much more thorough definition than I just gave.
Be issued at a discount to par and then mature at par, and that's basically how you get your interest rate. It's not a coupon-paying bond. Coupon-paying bonds, really anything beyond 1 year and whatever, and you get Treasury notes and then Treasury bonds beyond 20 years out, etc. Now, this is Treasury bills. Who buys Treasury bills? It's largely banks and credit providers. Why is that significant? The reason being is if a bank or a credit provider buys public debt, that is monetizing the deficit. Milton Friedman will be turning in his grave if he saw this chart pointing upwards. Right? This is pure monetization. Okay, no one realizes it's going on, particularly, but it is going on. Fact, right? Look at the number of government securities that banks are holding in their portfolios is going up, and this is testimony to this fact. The second reason is that Janet has been very clever in this active duration management because she's basically shifted the calendar not just towards Treasury bills, very short dated, but also among the coupons. She's actually issued a lot more shorter dated coupons, so in the 2, 5, 7 year year spectrum. So those are the tenors that are becoming more important. And as that happens, you're also encouraging banks to buy more of those coupon debt. Now, what that does as well is it starves the institutions, the pension funds and the insurance, the life funds, who want to buy long-dated debt of paper, of coupon
Mm-hmm.
paper.
Yep.
And what that does is it artificially suppresses the yield on the long bond.
This is a way to keep the yields from running out of control for like a 20-year bond, a 30-year bond, where you don't have to worry about it just skyrocketing and everybody going, oh shit, I should buy bonds. I should sell out of my stocks. Bond 20 years at 8% or 9%. There's no way, like, that's a way better risk adjusted return if I believe the federal government can pay me back. So I'm going to go ahead and buy these long dated bonds and just get the fuck out of the stock market. Well, obviously that isn't good for the stock market and it would cause it to go down. They want to control that. They don't want capital flight to occur. And so what they do instead is they issue these shorter dated ones, and they kind of force these guys to do this, starve them of the paper or the longer dated ones in order to artificially keep the yield down, and keep people from buying too much of it and then throwing off the stock market. That's probably my best explanation of it. Dr. Gonzo, if you have anything to add?
And that is what's called yield curve control by any other name.
Yes.
And it's happening. Reality, right? You look at the next chart, and what that shows is an attempt to try and estimate that. And it looks at the red line is basically a measure of the 10-year Treasury, what the 10-year Treasury should be based on its normal relationship with the agency mortgage market, right? So in other words, agency mortgages, which are issued by Fannie Mae, Freddie Mac, in other words, the US GSEs, the government-sponsored enterprises, are risk-free securities that the Federal Reserve holds. A lot of other central banks hold those. They're as good as treasuries. They've got the backing of the US government, and therefore you can treat them like treasuries. However, they have, in bond speak, they're longer duration and they have more convexity. So they're not exactly pari passu with a 10-year note. So what you've got to do is to do a calculation, which we do mathematically, to basically convert them back into equivalent convexity and equivalent duration instruments to a 10-year note. And that's what we've done there, and that is what the red line shows. There is another commentator on Twitter and whatever, George Robertson, who's done a very similar exercise.
Yeah.
He does it with I think a single spread, but he's traded the mortgage market and he knows full well what it costs to basically create a mortgage-backed security. And his calculations, I think, look very similar to this. Mm-hmm. Now, the orange line is the actual Treasury yield, and the black line at the bottom is the spread between the two. Now, what you find in that relationship is periods where the Treasury market and the agency market are trading more or less in line, duration convexity adjusted, of course, but there are periods where you get these jumps. What drives the jumps? Look at the next chart and you'll see. And what drives those jumps is basically what we call this yield suppression, and this is the black line. And what causes those jumps are growth in Treasury bill issuance. And you can see in terms of the growth rates there, whenever there's a surge in bill issuance, that yield suppression jumps out. And that is what is going on right now. Now, there's a lot of implications in this, which are really important for investors to take in.
Yeah.
If there is this so-called manipulation, active duration management, or yield curve control going on, whatever you like to call it, okay, what that means is that the Treasury yield, the actual 10-year note yield, is about 100 basis points below where it should be, according to the agency mortgage market, right? So what does that do? That tells us that the yield curve is actually inverted when it should be positively sloped. Now, that has fooled a lot of commentators in the same, well, of course, we've got a negatively sloped inverted curve.
This is very important. This is when people are talking about the 2 and 10 year and the yield curve inversion and how that's just a total sign that a recession is coming. So listen to this part.
It's going to be a recession. Well, there's not going to be a recession because in truth, the term structure adjusted without this bias, yield suppression, actually should be positively sloped. It's not telling us you're getting gangbuster growth in the US.
So what he's saying is the yield curve wouldn't be inverted.
But the number is small positive, so you're getting slow growth. That's exactly what we're seeing. Second implication is then saying, well, okay, what about the tips market? What is that telling us about break-even inflation? So if you look at the next chart, what that shows there is another adjustment. Well, what I've done is I've shown in black the University of Michigan consumer survey on inflation expectations. And what you can see is that black line is sort of hovering around 3%. It's been higher, it's been over 4%.
Here, I should fill in some gaps. The TIPS market refers to the market for Treasury inflation protected securities, or TIPS, which are a type of U.S. Treasury security designed to protect investors from inflation. Here's a comprehensive overview. All right, it goes into a lot more detail. But just so you know what the term TIPS means.
But it's gradually coming down. The orange line is what the TIPS market is telling you is the break-even inflation rate over 10 years.
And here's a more thorough explanation too. TIPS are bonds issued by the U.S. Department of the Treasury with principal values that are adjusted to the rate of inflation as measured by the CPI, Consumer Price Index. This adjustment ensures that the purchasing power of the investment is preserved over time. So really just think inflation-adjusted Treasury issuance.
So it's simply the conventional 10-year note yield minus the index link, the TIPS 10-year yield, and that is the break-even inflation over 10 years. And you can see there it's pretty much about to hit Jay Powell's target of 2%. So the FOMC should be happy about that. However, of course, we know that's distorted. It's giving the wrong signal. And what we should be looking at is the dotted red line, which is using the adjusted agency mortgage yield, in other words, 10-year note equivalent, to try and work out what break-even inflation is. And that's telling us it's more in line with what the Michigan survey is saying. So in other words, break-even inflation ongoing over 10 years is not 2%, it's actually nearer 3.5%. And that's a big difference. So what you're actually getting in the US system is financial repression, right? In other words, you're getting inflation embedded in the system that is being disguised. And that is why portfolios have got to have more monetary inflation hedges in them, okay? The 60-40 model of equities bonds does not work very well in a higher inflation environment, okay? We're not getting hyperinflation, but we're getting maybe 150 basis points more than everyone is expecting. And so what you've got to...
This is another reason why he believes, and I believe, that the Fed will end up settling at a higher level of inflation because we're embedding inflation into the process of issuance with the treasuries. So you have to have a higher level of inflation, even if you're getting disinflation from Chinese exporting goods that are way cheaper because they're desperate and they're just dying. It still doesn't matter. You're embedding inflation in the system.
do is to diversify your...
And this is good for assets, right? Like Bitcoin. This is good for them. Not so good for maybe returns in some markets and some stocks and things like that aren't going to just really outperform.
Portfolio more into monetary inflation hedges. Which is the best established monetary inflation hedge? It's gold, right? Gold is at pretty much an all-time high, and it's going to go higher.
I hate gold. I don't hate it. I don't like the appearance of it. And I don't think it's a good return. And it's only up like 31% in 13 years. But he's 100% right. I mean, it's been around for thousands of years. You can't really argue that point.
What is an empirical monetary inflation hedge? Looking at the record of the last 5 years, it's Bitcoin. It's a lot more sensitive to gold, to changes in liquidity and monetary inflation, but it's a pretty good hedge. So this is what portfolios have got to have more of if you believe what's going on. Now, we do believe what's going on because if you look at the arithmetic of fiscal finances, it's getting worse. And if you look at, maybe it's the next slide or a couple of slides on, you'll see this is basically saying one of the things that you've got to remember about financial markets right now. And this is a very important relationship. It may be wonkish, but it's an important thing to say. And this is looking at all
debt maturities. Yeah, when they mature, very important.
More advanced economies in the world economy, going back to 1980. And what it's saying is the ratio of debt, all debt, private and public, to domestic liquidity stock has averaged approximately 250% or there or thereabouts, okay? 2.5 times. That's what the average is saying. So you look at the solid line, what it's saying is that's the average. So if debt expands, liquidity has got to keep pace. And if liquidity keeps pace, that is monetary inflation, right? Now, what that tells us is that the world has become, or financial markets have become, debt refinancing mechanisms. And this is the point that our research has been banging the drum about.
They have to be just to survive.
We're in a business cycle that is dominated by debt refinancing, okay? Financial markets now are major debt refinancing mechanisms. They are not new capital raising mechanisms. Those days have gone, right? So it's not about capex and the cap.
New cap raising, like IPOs. IPOs were everything for a long time, right? Before the 2008 great financial collapse, and then well afterwards for years up until recently. IPOs. Just think about it before the pandemic in 2020. How many fucking IPOs and new companies came out that were just bullshit? WeWork, all this other stuff that were just non-profitable, that have failed essentially, and that have not been able to figure out how to make any money. That was the markets before, right? It was all about raising capital, but now it's about refinancing debt. It's very key differences in the way that the economy is operating right now.
CapEx cycle, and the CapEx cycle drove economies in a 9 to 10 year cycle historically. But debt refinancing is a 5 to 6 year cycle, which represents the average maturity of outstanding debt, okay, in the world economy. And that's the cycle we're in. And so liquidity has to keep pace with debt. If it doesn't, you get a financial crisis. And every financial crisis in the last few decades has been fundamentally a debt refinancing crisis. So no liquidity, debt can't be rolled over, you got a crisis. Okay, think back 2008, think back Asian financial
Exactly
crisis,
why.
think back UK, US.
2008, perfect example. Adjustable rate mortgage. You had 2 to 3 year terms where you had a fixed rate that was a great deal or a better deal. I had one of those around that time. My mortgage went up to 11%, I think, as a default because I was a new first time home buyer loan. I didn't know what I was doing. I didn't have parents that were great at purchasing homes and knew everything about all this stuff. I had to figure it all out on my own. So I got an adjustable rate mortgage that was for 3 years, and then it rolled up into a fucking insane rate, and I had to refinance it. And I was able to make that happen, but a lot of people weren't, and they had multiple houses that were on adjustable rates. One of my neighbors just across the street from me, she had an adjustable rate mortgage. She took out all these loans, made this house fucking beautiful, redesigned the entire thing. It was gorgeous. It appeared on the news because she did such a great job renovating her home. Fast forward a year and a half later, and she's living with her fucking parents. So the problems that we had with refinancing in 2008 was a very real big deal that I don't think people appreciate enough, and we're just not in those same situations. We had an abundance of inventory, massive amounts, way more than this Airbnb scare that some of these venture capital consulting people like to talk about. Somebody who's been calling about a housing crash for the last 4 fucking years. There's just so many other issues. You think he'd know these things, but some people don't. So, but it's just very important to take note of how different 2008 was versus today.
Repo crisis in 2019, all about debt refinancing. The dotted line on that chart is taking into account the maturity wall. And because there's been a lot of debt refinancing and low interest rates recently, if you take into account the maturity wall, we're actually fairly comfortable right now. Okay. So it looks as if looking at that.
Yeah, so again, the dotted wall, all the maturities that are coming in are such low interest rates that we don't have to worry about this massive amount of debt issuance really inflating the economy and maybe making things run out of control and having like a meltdown like we saw in 2008 where people, commercial real estate, where people just, are having issues with debt. Not just the bottom 1/3 of the country, but a lot of people.
Solid line that 2024, 2025 are going to be rough periods, tough periods for debt refinancing. But the dotted line saying, taking into account the maturity wall, actually it's not so bad because there's not a lot of debt which is coming up for refinancing now. But 2026 may be a bad period, or 27 may be a bad period. But all it's saying is taking that into account. So this is important. So what you've got to say is, number one, monetary inflation is starting. Number two, monetary inflation is driven by this ratio between liquidity and debt, and ultimately debt is expanding.
What's up, everybody? Just want to take a second out of the show to talk about this.
Okay, probably Monta or something again. Yeah, now guys, I don't know how much you're getting out of this. Hopefully you're getting a lot. If anybody has questions, don't feel dumb. This content, this is not simplistic macro level details. For a lot of people, this is like fucking Greek. So if you have questions, don't hesitate to throw them out. I'll try and answer them to the best of my ability. But this stuff is not easy. I just want to be clear on it. But it's so critical, I believe, into making a lot of money. It's why I made 7x in 2023 off my investments and got so rich. It was because I was able to follow Michael Howell and realize that global liquidity was expanding and we were at the bottom of a market cycle, and it was an opportunity where I could leverage in with options, something I hadn't used for years before that, with Facebook, or I should say with Meta, with Tesla, with Palantir, with a number. Square was another one I did well. 500 to 600% returns off of Robinhood. Just a lot of things. What was it? There's a bunch of them. Matterport. I doubled my money. Could have made a lot more, but I didn't realize they were going to get bought out. So many different investments where I did really, really well by leaning in and leveraging at the appropriate time, because these tools, you don't always use them, but you use them when it's right. And it's because of people like Michael Howell with CrossBorder Capital. I think he's hard for a lot of people to follow because he's just so fucking brilliant. He's like Lynn Alden brilliant, maybe a little bit better, and in my opinion. So it can be hard to follow, but if you have questions, man, just say it.
And that's saying, well, okay, let's look at debt. How is it growing?
Especially with acronyms and all the bullshit.
In the world economy. So this is looking at the ratio of public and private debt as a percentage of world GDP. And what I want you to focus on is not the orange bit, which is the private.
Resources do you recommend for better informed about these? I'd say me. I'd say me, Ariel. I don't want to be arrogant, but I've spent a lot of time trying to figure out macroeconomics, and I've listened to really brilliant people, and I think I can convey it in a way that's easier for people to understand. And if anything else, I'm just accessible where I can answer questions, whereas it might be harder to pull in a Lynn Alden or a Michael Howell just based upon their status. So I'm happy to answer them whatever I can. Yeah, dude. Honestly, Ariel, ChatGPT, totally agree. I don't love ChatGPT. I think it's a little too woke for me, but I do think that as these AI search chatbot engines get better and better and better, they're huge. I use Grok all the time. Arguably, it's better on some metrics. Other things, it's worse on. I do think it's better for more relevant current data. So I use it like crazy, especially not mini beta, but actual 2.0. And I think that you can get so many answers from that when you don't have the answer to, like when you're listening to something and they're talking about like tips, what the fuck is a tip? You can literally look that up and get really good answers. And in Grok, you can even find relevant articles that might pertain to the topic. So that is a great way to do it, in my opinion. And you're right, no stupid questions. This is not easy stuff, man. And if you know all of this already, you're probably not watching the fucking video.
Sector, which is pretty well controlled, that may be dipping down. This is up to the end of 2023. Look at the red area, which is public sector debt. Now, at the beginning of that period, that little box and the number 56% was basically the ratio between government debt, public debt, and world GDP, 56%. Now where it is,
Yeah, look at how much government debt is expanding and private debt is shrinking. This just leads to the other topic that he was just talking about a second ago. We're not in a CapEx cycle where we're seeing a lot of private debt expansion. We're seeing government debt increasing in order to be able to create liquidity. Very cool stuff.
160%, right? And it's going up. And if you look at the next slide, you'll see some of the dynamics there. And what we show
I mean, not cool for the economy over the long haul, but very fascinating. Sorry.
is US public debt. And this is not, hitting on the US. It's just the fact is that the CBO, Congressional Budget Office in the US, is so transparent with the data. It's really easy to look at US numbers, okay?
Yeah, I will make this argument about Michael Howell. I think he's overly optimistic about the situation in China because he uses like government resources for debt and everything that's going on, and we're much more, I shouldn't say very, we're much more transparent than countries like China, where they've removed 95% of their economic data since the pandemic. So I think he's overly optimistic on China, and I try to factor that into my equations. He thought China was going to do a lot better in 2023 than I did because I knew what the situation on the ground was and how bad things were after 3+ years of lockdowns and COVID restrictions and destruction of capital and business and just a lot of stuff, man. So when we're watching these, just keep in mind that he's more optimistic about China than I am, and I'll try and interject where I disagree with him about things.
So the US is a very transparent economy to watch. One of the things that you see there is, you see in these columns, after the date column, the first column is the primary deficit. So that's basically the US deficit before interest payments. And you can see that, according to the CBO, is running on at these sort of decently high percentages. Of course, it may be a lot worse than that. And if you've got a lot of government outlays because of Medicare and Social Security, and you've got more defense outlays, that number is going to go up, go down.
Yeah, so he's saying that if Kamala Harris gets elected and she has any kind of power over the House and the Senate, that we could see public debt expand greatly.
The other thing you've got to take into account is the Congressional Budget Office does not ever forecast recession, and recessions cause big blowouts in deficits. So that's not in these figures either. So they're going to be bigger, not smaller than this. Look at the interest payment number. And that number is not because interest rates are going up necessarily. We've kept them flat at really current levels. It's because the debt GDP ratio itself goes up. Now, the question to ask is, why was it in 1980 that Paul Volcker could hike US interest rates to 15%, right, and not cause a problem with the budget deficit? Reason being because debt GDP was a small percentage of, it was then basically 40% of GDP.
Yeah, this is really good. You don't see this in a lot of places, but right in the middle of this chart, let me go here. Right in the middle of this chart, you see the section that says gross debt to GDP. This isn't a figure I see a lot of people paying attention to, but it's very important. You can see that in the 60s, it was 60% debt to GDP. So we were still good. We were outgrowing our debt loads. You can see where we were doing fine really in the 2000 range, right? It was good. It's like we actually were balancing budgets in 2000. Was that Bill Clinton? I don't remember anymore. But but we were seeing that debt to GDP was not bad and it was manageable, even though at that time people were complaining all the time. People were complaining all the time about the debt loads being unsustainable, but they were actually really fucking sustainable. And I was ignorant enough back then, I didn't know anything about anything. I'm like, oh my God, number go up, scary, bad. But it really wasn't. But you could see after 2008 how it doubled. And you could see here with 2020 in the pandemic how that number went up a lot more. And then we're seeing growth of the public sector debt increasing. This is stuff that the liberal democratic institution is already doing. They're giving us well into double digit public debt growth. This is not a sustainable number. And it can become problematic in the future. But let's listen to the rest of what Michael Howell has to say.
Now you've got a figure which is probably, in terms of gross debt, it's more like 130% of GDP plus. And that means that
China, by my calculations, is closer to 350%. Imagine that with the shadow banking sector. They were in 2008, they were the least indebted major economy on earth. And they were sitting pretty. They had tons of cash. They had the ability to basically ignore 2008 great financial crisis because money was still being invested in their country, and they were able to expand and build, and they got all that emerging market kind of benefit around that time. That's all gone. They're in a completely opposite spectrum now. They're in a world of fucking hurt. You need to understand this.
interest payment is, what is it, 3 times, almost 4 times as big as it would have been at the time of Volcker, even though interest rates are lower. And that's a really significant factor. This is the power of compound interest. And what it shows is the growth of public debt. And this is significant. Now, if you compare public debt with private debt, which I may do in the next slide, what that's showing is the contribution to US credit growth. Now, even though the orange bars, which is our estimates of the growth in private credit, are subdued relative to history, look at what happens to public credit growth. And this
It's just massive. It's double digit now. It's much greater than we saw in the 70s, the 80s, the 90s. And basically every time before, we're looking at a 50 to almost 100% increase in the growth of public debt. So this is a big deal, or I should say governmental debt.
is basically the deficit. So it's a little bit like, going back to the old adage that Milton Friedman said, if you want to understand the tax rate in the US, look at the rate of government spending, because that is what you're going to be taxed on, either directly.
And this is also to my point in regard to Harris or Trump. I don't even know that I love Trump, okay? But when you look at the difference in policies between these two, they're astronomically different. One wants smaller government, which means less taxation, which means that we're going to see less of this craziness in the U.S. budget deficit. In regard to these projections, we would see that start to come down. But if Harris gets elected, the same person who didn't want $1 trillion for a stimulus package that Biden got approved from the Build Back Better plan, or the the Inflation Reduction Act is the one I'm talking about specifically, the one that didn't reduce inflation. She didn't want $1 trillion. She wanted 4. And so just imagine this lady if she gets power. And the presidency and the House and in Congress, what these numbers would start to look like and what taxes would start to look like across America. It would be runaway in a very short period of time.
In terms of federal taxation rates, or because of inflation. It's one of the
I don't know if she could destroy us in 4 years, but it'd be close.
two. But that is the cost of taxation. Inflation is a tax. And what we've got here is growth in credit that's coming through because of the public sector. And you look at these growth rates, they're, eye-wateringly large. So what I'm saying here is this is the growth of monetary inflation. And if you get monetary inflation, the way to hedge that is by looking at gold and Bitcoin. And I think in the next chart, or it's the next one, or this is the one. Yeah, this is looking at the long-term chart, which shows in black there global liquidity since the mid 1970s. This is a figure which is touching $200 trillion now. The orange, measured on the right scale, is the market value of gold and Bitcoin.
Look at how close they are in correlation to each other. This is a very important thing to understand. Let's see, what have you guys said in chat real quick? Let me check. Needs 55, thank God for this video, as they can go back and catch the info we missed and maybe not are clear on. So you may get more questions later, Jesse. Yeah, I'm happy to answer, man, if you guys throw in my comments. Dr. Gonzo, it can be helpful to understand how governments have historically serviced the debt through inflation. It devalues the debt that they can pay it back. Yeah, dude, we have debts from the Civil War that we haven't paid back. And you know why? It doesn't fucking matter anymore. It just doesn't matter anymore. So there's things that can be pushed off in infinitum, like for a very long time. Yeah, Chris, all governments are so leveraged. Inflation will continue to go. Here's the thing. They're so leveraged. We're so leveraged right now that without reducing spending, without incredible amounts of growth in GDP from companies like Tesla, without Bitcoin being a reserve asset and basically helping offset our debt loads based on our money printing, without getting some really positive measures in effect, it's very scary for the world. It's very scary because it would turn into runaway inflation over time, especially if any other major anomaly black swan events happened. We could be looking at 30% inflation in a year in the United States. Crazy shit that people can't even grasp right now, losing a third of your purchasing power. Just stuff that we can't have. And it's why I believe, and I'm going to say this for hopefully the last time today, because I really go out on the diatribe about this. But this election is so important. People are acting like it's not important. It is more important than any election I think we've had during modern times in my lifetime. And I say that. I don't say that to just bloviate and get clicks. I believe that's very, very real.
Right, together. Those are what we deem monetary inflation hedges. And they are, if you like, keeping pace with the movement of global liquidity in this chart. Now, one of the things that we keep stressing is that gold, which has been the most long-standing monetary inflation hedge, is not a hedge against high street inflation. Okay,
Retail inflation, buying at the store, that kind of stuff.
that's what people misunderstand. It's a hedge against monetary inflation. The dotted line on the bottom of that chart is US CPI inflation, indexed back to 1975. So monetary inflation has been a scale factor bigger. So how do we rationalize that difference between high street inflation and monetary inflation? Because of productivity gains, because of technology, because of China dumping cheap goods into the world economy. All that's meant the high street has benefited hugely into.
So he's basically saying regular retail inflation has been lowered by like the fact I could buy an 85-inch fucking LED television right now for like $1,100. And years ago, I bought a 27-inch LCD for 4,000, and it was so tiny because of the way they measure it. It looked much smaller than my 27-inch CRT. So again, just like what you can get. This is very important in regard to like Jeff Booth, The Price of Tomorrow. That's why I recommend that book all the time. What you get in ways of technology and advancement over time, and how much cheaper that gets, has been offsetting inflation and making it to where the CPI inflation isn't nearly as great as the expansion of monetary inflation from government money printing. This is a concept you have to understand. This is why, and he's talking about how gold. Well, anyway, I'll let him finish his thoughts on gold and crypto and the rest of this. It's probably, and then I'll add my 2 cents.
In terms of lower prices. Now, monetary inflation can spill over into high street prices, and it will come through, pari passu 1-to-1 on the basis that there's no productivity gains, there's no China, and there's no technology gains.
Yeah, so if China isn't deflating the cost of goods, if we're not producing a lot more, if we're not innovating, then you can have problems where the monetary base expansion could start to run wild with CPI or high street inflation. Sorry, I know there's so many of these terms, so I'm trying to help wherever I can.
And that's really a question for people to judge. But fundamentally, gold and empirically Bitcoin are monetary inflation hedges which have got to be in portfolios. And that's really the story. And it comes back to the fact that you need liquidity because debt is rising. Liquidity is shown here as the driver of monetary inflation. And that is what is causing gold and Bitcoin to test all-time highs. And they're going to keep going because governments have to spend money. And there's no way out of this. And,
this is the most important thing you can realize. And then you have to also take the fact that Bitcoin is a fraction of the size of gold, and that it's I can't say more liquid right now, but it's probably close. If you look at daily like average volumes and stuff, you're probably looking at that. But It's immutable, it's transferable, it's more easily divisible because you have the concept of Satoshis that go 8 decimals deep into Bitcoin. So people are like, well, how could you spend a Bitcoin? It's $60,000. Well, it's like, no, it's divisible down to the 8th decimal. It can actually go to a much lower number. But it's got all these benefits that Bitcoin has over gold, on top of the fact that it's a much smaller market cap than gold. And so you could see wealth that is currently being stored in real estate. Again, real estate values are up 40% since the pandemic started. People on average have their value of their homes up 40%. Some are double, some more than that, depending upon where you're living and what the demand looks like. So these people have just captured tons of wealth, right? Well, it's in a liquid asset that you can't easily turn around. So if in the near future here we see wait a sec. George said, George Maness, member for 6 months. You are a stud, dude. So this person pays me $10 a month, and they've been here for 6 months. You rock, bro. Thank you very much. But yeah, so you see this liquid asset in real estate that isn't easily sold. And that here in the near future, when rates start to come down, my thesis is that existing home prices also go down, and that this puts pressure on new home sales and existing, because people are all of a sudden like, hey, you know what? I want to upgrade. I want to get that house that dropped by 25% in value because it's like $2 million. There's one I'm literally looking at that was $2.5 million, and it's getting closer to 2 right now. I'm not in the position to buy it yet, but I've been watching this. And again, and this might not happen right away, but it could happen over a period of time. So I think it's very important to understand that people will move their wealth in small percentages. Maybe it's 1, maybe it's 2% of real estate, maybe it's 1-2% of bonds, maybe it's a couple percent from equities. They'll pull from these other things. Maybe it's a couple percent from gold, and they will buy Bitcoin because it's just a much easier way to store your wealth, and it has a better multiplier behind it for upside price action. And people talk about how volatile it is, but if you like making money and you have a 4-year time frame, it is the best asset on earth that you can own historically, ever. So this is just a concept that I want to make sure that you guys understand. There is a reason that Michael Howell talks about Bitcoin, even though historically for thousands of years, gold has been the asset that you hold on to. Bitcoin is going to be a much better version of that right now. So I just want you guys to understand that. I'm going to play this for a second here. I do need to grab something real quick too, so I'm going to put you on full screen.
Hopefully these slides have shown that we're in a very different regime. And that different regime began in 2008 when governments came in and basically spent money to bail out economies. And COVID came and they spent even more money. And you look at, US government outlays are up 40% since COVID, and they're not coming down.
No, they're not coming down at all. Michael, that was such a fantastic thesis articulation. These are some of the most important components happening, I think, in global macro right now. Maybe what we could do, I've been jotting down a few quick Q&As that we could potentially do on some of these sections and just go back for a second here. So the first question I have is just around this idea of managing the bill issuance percentage versus going to longer dated coupons, and this idea of this yield curve control. So again, like you said, Yellen has been issuing a very high percentage of T-bills. And when I pair that with what you're talking about with the maturity wall coming up, and this rate cutting cycle that's incoming, when you look at what's going to happen over the next couple of years, do you think it'd be something like, keep floating this bill issuance until rates get quite a bit lower and then refinancing it all at these, longer duration tenors? Do you think that's what's going to occur? Or do you feel like it's going to be this continuation of a higher
Great
percentage?
questions.
Well, I think they've got to be.
I just wanted to say really great questions from whoever is leading this conversation at Blockworks Macro. I'm going to try and figure out who he is. I think it's Felix down here. I'm going to try and follow that guy and see if I can find out more about his thesis on a lot of different things, because he's doing a really great job.
Opportunistic here, but the fact is that a T-bill is always easy to sell because there's lots of rate buyers. And if you think about how the monetary system works, if the government is writing checks and bank deposits are going up, then the easiest way to match a bank deposit is to buy a Treasury bill, and that's a pure monetization. So they can easily do that. Okay, that's point number one. So I think it's opportunistic, but I think they will. I'm cynical enough to believe that at some stage in the next 1 to 2 years, the US authorities will try and create a recession to actually force investors back into the Treasury market, because I think they have to do this. Governments, one of the things that many economists say is if you look at the debt GDP projections of the Congressional Budget Office, but at some stage in the next, that's
I want to hear this
again.
again.
I think it's opportunistic, but I think they will. I'm cynical enough to believe that at some stage in the next 1 to 2 years, the US authorities will try and create a recession to actually force investors back into the Treasury market, because I think they have to do this.
That's fascinating. That's fascinating. I hadn't thought about that. It's going to have to be very controlled, though. It's going to have to be very controlled because you have issues where if you had to raise rates again, you could have a sovereign debt crisis. I don't know. The government could probably account for that in different ways, just buying their own debt. Japan's been doing this for decades, and people said it wasn't possible. Or you could have issues with, carry trade types. You could have problems. It's going to be fascinating to see if they can pull this off. But I hadn't thought about the fact that they could be forcing people out of equities and into bonds in the next 2 years when the liquidity cycle starts to drop. That could be brilliant as far as hedging, guys. You get ahead of that. You take the cash that you're getting off of really good investments, if I'm right about the fact that we're going to go up over the next year plus. And then you start to put some of that into bonds as a hedge and ability to be able to handle downside price action. And you might do really well in the bond market, maybe with a TLT or a multiplier. But I wouldn't do TMF probably at all because it's like a 3x multiplier, I think, to TLT. I wouldn't do that because you don't want to hold that for long durations of time. But maybe a TLT, if you're starting to garner cash over the next, several quarters, is a good idea to build up. That's probably going to be a thesis I operate off of. It's one I was kind of thinking about before, but it's I've never heard anybody say that the government might orchestrate a sell-off in equities in order to be able to get people back into the bond market. But they might have to. They might have to.
Governments, I mean, one of the things that many economists say is if you look at the debt GDP projections that the Congressional Budget Office is coming out with, which are figures like, probably something like 180% gross debt to GDP by 2050, those sort of numbers are unsustainable. The fact is they're not unsustainable. They're very sustainable. Governments can always fund themselves, or basically reserve currency countries can always fund themselves. Look at Japan and look at Britain in the 1950s, okay? They had much, much higher government debt to GDP ratios, and they still survived. It may have adversely affected their economies. In other words, government spending.
I didn't know that about Britain in the 1950s. I'm going to have to research that time frame more to understand what they went through. I know Japan's been doing it for a long time, and people said it was impossible. So that's fascinating.
Browning out the private sector, and you've got very slow growth, but governments still basically funded themselves. And that's the thing to remember. Now, if you start to look at the math of this, it's really quite interesting. And for every 1 percentage point on the US primary budget deficit, we reckon that by 2050, the debt GDP ratio goes up by 22 percentage points. Okay. For every 1 percentage point on the interest bill, in other words, let's say 1% higher on bond yields, what you find is the debt GDP ratio by 2050 goes up by 35 percentage points. This is an eye-wateringly large number.
That is fucking insane. What?
And it will focus the attention of politicians and policymakers because it will mean that they have to try and control yields and keep yields down. You cannot afford to have interest rates go up. That is why neither Japan nor China can tighten. Okay, Japan is in a far worse situation than America. Already the BOJ owns 100% of the bond market, so they just can't afford this thing.
Yeah, people don't realize that the Bank of Japan owns 100% of their own bond market. So many ignorant people talk about how if China sells all of their U.S. held treasuries and bonds, that the United States will melt down. History tells us that's not true. They could just own it all. They could own it all. They could own all of the treasuries from Japan that Japan holds right now too. So again, just remember all the levers that are used behind the scenes and what history tells us. It's very important. A lot of people don't cover this stuff. That's what I try to specialize in, along with just listening to brilliant people and taking the time to understand them. If you guys do appreciate that in any way, if you could hit the like, chat, do all the stuff, that's really great. It helps me a lot. Make sure you ring the bell so you can hear more of this as it happens.
Let this thing unravel. So they've got to keep easing. And despite what Ueda says in Japan, the governor of the BOJ says about raising interest, their hands are tied. They can't do this. So we're in a situation where you've got monetary inflation.
I actually think that the threat of raising rates in Japan, that was basically them saying, hey, Janet Yellen, Jerome Powell, you guys need to give us a break. You guys need to figure out something. I don't know if it's some like kind of hidden swap lines or what it is. I don't know what it is, but the markets have really stabilized. And it's either just the Japanese carry trade, like you said, wasn't that big and it unwound and everything's okay, or there's something being done behind the scenes between these central banks in order to ensure that there's liquidity there and that things are going to be okay that we don't know about right now. And I mean, I'm sorry, if you don't believe that the government's capable of doing stuff like this, then you're not paying attention to what governments have done for hundreds and thousands of years.
going on. So I think that's it. One of the other things I think to say is that if you look at what Janet has done in terms of the US issuance calendar, she has reduced the average maturity in the last 18 months by about 1.2 years. Now, that's a significant drop in the average tenor of US debt that's been issued. And our calculations would suggest that that's a
I think, Chris, real quickly to kind of go into the conversation that you guys are having. Let's see. Dr. Gonzo, interesting point. Dr. Gonzo, for force people out of equities, unrealized capital gains tax would do that. Yeah, but I don't think you. I think it wouldn't be that. I don't think it would be a taxation thing where you're trying to force that into markets. There are plenty of things that they could do with Treasury issuance, and then again, just a slight tightening of liquidity to send things over the edge to cause a drop in the stock market. You don't need to tax the shit out of people to do that. And plus, again, that taxation could actually slow down growth, create a death spiral. Really bad shit. I don't think that that's something that they would do. What if they don't, Chris says, what if they don't go back and do T's at that point? Civil war, scary shit. People will go back into it because, again, clean a shirt in the dirty laundry. Well, I mean, it depends, right? Like if we're a socialist, communist dictatorship or heading that way in 2 years because of who's been put into office, shit could get pretty scary and we might not easily get people back into the bond market. And that would be a fucking disaster for the entire world. I wouldn't be worried about civil war. I would be worried about world war because that's kind of where these things tend to come from. If you're a student of history, you know that, Germany suffered greatly and that's what brought up Adolf Hitler, who then invaded all of his neighbors because they were going through their own depression. So we don't want to see China get crushed. We don't want to see us get crushed. People that root for these kind of things are rooting for the end of the world. And I'm not one of those people. I'm an optimist. I want to figure out where are the solutions. What can we do? What will people do? And I don't think so. Again, if we have a really dark dystopian, we're a communist state, Kamala's president, she's full-blown, Marxist garb and talking about how great her father was at Stanford doing Marxist economics, then we're in trouble. But if you talk about somebody like, Trump being in power and we're starting to reduce government spending and we're finding efficiencies and they're starting to give contracts to Tesla and SpaceX because they fucking deserve them, then that's a whole nother world. And you could have a market roll over and then you could get people into bonds because they would invest in bonds, right? If they look at America as the last bastion of freedom of speech, unlike places like the UK, France, Germany, as of late, and we're still free and we're encouraging capitalism and we're seeing growth and we're seeing reductions in our debt, then you could have a much different situation than what you would have on the other side of that if we're taxing the shit out of corporations and we're seeing government debt expanding exponentially. They would just be two totally different scenarios. And it's the message I'm trying to get out to people too so that they understand that.
Alone has taken.
Cashman, famous saying, let's not forget the German central bank. Or he's saying somehow investors would have zero options. I don't think they'll have zero options, but one of the things I wanted to cover, Chris, is that if Bitcoin has just hit a cycle peak in a year and a half, if equities have just hit a cycle peak after a year and a half and we're much higher and we've had a melt up, like a lot of people like Henrik and some other friends of mine, Mortensen Bach and others have talked about that are even more influential. If we have that kind of melt up upwards and you've already gotten wicked gains off of Bitcoin and you've already gotten wicked gains off of equities and you've already gotten wicked gains off of crypto related investments, if the market turns down, where are you going to put the fucking money? It's in the dollar and it's in bonds. That's it, right? And you're probably going to want to lock in a higher interest rate in bonds so that you can just have some revenue coming in with all the money you've made so that you're safe and you can ride out the storm. And so again, I think that's kind of the path that we end up taking or going down. And yeah, the dollar is breaking higher, Jeremy. You're right. It's doing exactly, though, what I said it was going to do. Real quickly here. So if we look at my chart, I drew this green line and I said, hey, guys, this is going to be support yet again, right? And it's doing exactly what I think it's going to do. What he's talking about is with the burn down of the Treasury general account, with a lot of things that they can do behind the scenes and levers they can pull, he expects the dollar to weaken even more. And I would love to hear him being right. He said we dropped down from the 106 mark, Michael Howell. and that we could drop even lower. And if you look here, even at the monthly time frame, we could drop lower. We could drop lower, and so maybe he said the lower 90s, like maybe even 96 or something. I mean, technically, let's look at the weekly time frame and see what this looks like. We are hovering right now above the weekly 200 moving average, and trying to find support in the range I was talking about. If I am wrong, and I'm starting to update my thesis for this, just listening to Michael Howell today. But if I'm wrong, again, we're oversold on the weekly time frame. We're definitely that. But if we get a bounce up and then roll underneath this 200, maybe he's right. Maybe we get into the 96 and to the low 90s before we actually start to see any kind of strength in the dollar, and that would be really positive for equities. And again, it would be artificially created by the government. And I'm starting to think that he could be right about this. So I just wanted to throw that out there. Let's get back to it. Let me find him real quick.
50 basis points off the 10-year yield.
Yeah, that makes sense. And then as that maturity comes down, so does the duration. You mentioned how they need to basically, create demand for the long end. And I think a lot of that right now is, they basically need to re-steepen the yield curve because, who wants to buy the long end right now when term premium is where it's at? Do you see that as, having the short rates come down? Or, like you said, they can't really let the long...
So again, if I'm right about this, and Michael Howell's kind of right about a lot of this, we could see the yield curve inversion at like last for a very long time as it's being controlled by the government. And it's actually maybe already uninverted, but we won't know about it until it's much later. And then people will be like, oh, well, actually, if you look at it, based upon tips and all this other stuff, you'll see that it uninverted like a year ago. So you can't be like freaking out off of an uninversion that already came and went and you just didn't know it because of the artificial change in inflation rate that's being used right now versus what these bonds should actually be going for.
Long and expand higher.
Hopefully I said that clearly. I don't know.
That much. So you think it's mostly like a bull steepening to create that demand?
I think they'd be really lucky to get a bull steepening unless they create a recession. Yeah. I think it's much more likely you're going to get a bear steepening. And I take the point that if you're cutting policy rates aggressively, you're going to get a big rally in the 2 year. That always happens. But at the longer end of the market, you've got this bogey of negative term premium to jump, and that's a significant problem. Why you've got negative term premium is baffling. But I think it's to do with this yield suppression thing. You shouldn't have negative term premium. They should be probably positive by about 100 basis points, but that neatly fits in with this degree of yield suppression that's currently.
And again, what he's talking about with the negative yield premia is he's talking about the 10-year inversion and the fact that we're uninverted right now. We're real close. We're real close to, or I should say, we're inverted right now. We're close to uninverting and going positive on this. But what he's saying is that probably won't happen. But behind the scenes, it probably actually already has uninverted. You just can't see it. So that's the nuance I want to make sure you're understanding.
Going on. If you issue a lot of coupon debt, you're bound to get.
And real quickly here, I do have to answer to this. You talked about Art Cashman, Chris. It's a great saying. We've talked about this a few times, me and you. It says, the end of the world trade only works once. And if it happens, who's going to be around to collect from? And again, we can say, going back to 2008, that we haven't really had any major economic downturns outside of huge black swan event where we shut down the country in 2020, and then at the same time, like maybe 2018, 2019, where we tried to raise rates just to see if we could, and we couldn't because the market started to go down really quickly. So again, the end of the world trade, as popular as it is, I mean, wouldn't it be funny? Wouldn't it? I shouldn't say funny, but wouldn't it be ironic if we make a bunch of money over the next year and a half, understanding how global liquidity works and listening to people like Michael Howell and Lynn Alden and a bunch of others, and understanding that the markets are more likely to melt up than down over the short term. And then we can benefit from being able to jump into bonds and having cash and making money off of interest, and maybe like making, like, again, if we can make 5%, 4% even off of our cash by that time, and lock that stuff in for a long period of time while the value goes up and the yield goes down, it could be a great benefit, especially if you jumped into TMF, that 3x TLT 20-year bond fund at the right time. You could do really, really well off of that while the world is potentially melting down for a short period of time. And again, even if we look at 2008, guys, the market within a couple of years was back up to where it was before the major drops. So you have to realize that when these things happen because of the fact that we have to spend our way out now in order because of our debt to GDP being so high, there really isn't. It really just won't be a long time. It won't be. Just like look at 2020. The market fell apart, and then within a year, we were at all-time highs and crushing it. Not even a year. It was just an insane fucking turnaround. That's the kind of stuff we have happening nowadays. And if they can get people into the bond market, if they could get enough people rushing into that and locking in rates, then they can start juicing the economy again in 2026 or whenever we start to see this breakdown that they might artificially create. I'm really getting sold on this thesis.
Term premium rising. So
we're going to have to find people that oppose this thesis, that are intelligent, and see if there's a good reason why.
I think you're more likely to get a bear steepening, but at the end of the day, they can't afford that because a bear steepening will increase the cost of government debt, and so you're in this vicious circle. And so they're absolutely compelled to shift issuance towards the shorter end tenor.
Yeah, he's right. They can't do long-dated bonds. They can't do this bearish steepening where they allow the bond market for the 20 and 30 year to go a lot higher because they can't afford to pay the debt for that long of a period of time. So they have to do this, this yield curve control. They have to do this stuff in order to be able to make it to where the market is sustainable and it doesn't collapse. It's what it is, man.
And to use a lot more bill finance. But as I say, that's monetization pure and simple. And that's why monetary inflation is coming. I just can't see how you can get out of that.
Totally. Do you think Treasury buybacks fits into that whole framework, or what do you think is the real motivation there?
No, I think
there's
something different. I think the Treasury buyback thing is to reduce volatility in the market. And the reason that's important, and this is again getting into the weed side. Now, this is looking at the global liquidity creation mechanism that's well worth understanding.
Can countries, Albert said, stupid question. Yes, Albert, it's super stupid. No, I'm kidding. Can countries agree to write off each other's debt to each other? Yes. That's usually what happens after World War. You have winners and losers. You fuck the losers, and then the winners benefit. So Germany did not do well after World War II, and so on, right? Like so yes, you do rebalance, and basically the power that wins takes advantage of the power that lost. It's horrible fucking thing, but right, but that's how it works. And then it takes these, and then they end up taking the difference on this, fucking these other countries that lose, enriching themselves at the same time. It's why the war machine is so popular for rebalancing debt, and it's why I don't want our debt loads for us or China to become much higher than they are. Because I don't want this incentive for war, in order to be able to have an agreement on reorganizing debt.
Understanding, because this is critical to how we go forward. What you've got on the base of this inverted pyramid are things like central bank money, in other words, central bank balance sheets or liquidity injections. You've got cross-border flows, and this is things like what used to be dominant, which was the euro-dollar market, but is now fizzled out to really nothing. And then you've got FX swaps, which are increasingly a large part of sourcing dollars or liquidity for the system. And then you've got another block, which is collateral. Now, if we put that together, that's what we call the shadow monetary base. And the leverage between that base and global liquidity is a multiplier that's about 1.8 times. Now, what drives that is volatility in the bond markets. And if you look at the next chart,
I love that. Shadow monetary base equals 100 trillion US dollars. And people are worried about our debt, right? The shadow monetary base is like 3 times the size of our federal deficit. I hope you guys realize that.
What it shows is the size of that collateral multiplier. So you can see that that's been trending upwards. It's lately been dipping down, but generally the trend has been upwards. And you're now looking at a sizable, meaningful multiplier in the system. Now, what's driving that multiplier? Go to the next slide, and we focus here on the MOVE index. Now, why do I look at the MOVE index and not the VIX index? The reason is that the MOVE index,
again, bond volatility index. Think of that. The VIX is the stock volatility index.
Is fundamental in the system, and the MOVE index measures the volatility of the bond market across the curve. Okay, so it's the average volatility. It's shown as an index. The way that I normally read that is that the long-term average is about 70 on that index. We're currently at about 105 or somewhere between 105 and 110. 70 means, on average, my read is you've got 7% annualized bond volatility across the curve. So an average bond will move by about 7% on average, up or down every year. So what this is basically saying is you've got bands here. Now, when I was active in the bond markets at Salomon Brothers, when you got a move.
Albert, to answer your other question, you said, but for example, could theoretically U.S. and China agree to write off, let's say, $1 trillion in U.S. each other's debt? No. doesn't work that way because they have relationships with other counterparties probably isn't the right word, but other countries around the world too that have debt loads. And also to what is the likelihood that the U.S. and China are going to write off any levels of debt? You got to realize when you do these kind of things, it's not a win-win for both sides. One side is getting fucked, and the other side is benefiting from it. So that's why war is usually the answer for that, because one side doesn't want to get fucked. So no, it doesn't work quite that way. There has to be a loser. Yeah, exactly.
Index that was anything over 150, that was really the end of the world. Okay, it was all, that's when the lights went out. We actually got up, as you'll see in the COVID crisis, higher, and we got in 2008, up over 200. So broadly, I should have said actually in COVID there was a spike, which is not really reflected there, but this is monthly data.
A very high spike during COVID. Very high spike.
But you got up to very similar levels at that time as well.
Here, I'm just going to show this real quick. I'll show the one I show you guys. So this is his view of it. And then this is our view of the bond volatility index. And we can go back a little bit further here. And again, this is weighted a little bit differently than what he represents, but it's close actually. If you look here, you'll see what he's talking about in 2008, where we had just this crazy period with the bond market where it just shot through the roof. You could see that again, not represented in his chart, but you could see how that happened over here in March of 2020 as well. And anybody who knows about rates getting raised in 2018-19, you can see that the bond market didn't care about that at all. It really didn't bother it, honestly, in comparison. It was the pandemic, and then it was more recently here we saw a spike that he isn't referencing either in regard to the March 2022-ish timeframe. This is the Silicon Valley Bank incidents that we saw where everybody was afraid of, like, is my bank going to be liquid? And people were literally moving assets to like JP Morgan and opening accounts with them and anybody that they thought might be safe because they were afraid that maybe the government wouldn't cover the money sitting in their bank account. So crazy shit happening there too. But I believe that this is headed on a downtrend and that we're getting ready to see that happen more so in the months and quarters ahead, and that will be conducive to the stock market doing well. And if Michael Howell is right, and we continue to see shorter treasury bill issuance, and you see them artificially suppressing the yields on these higher dated bonds, like the 20, 30 year, et cetera, even the 10, if you see that kind of stuff where they're not issuing a lot on that so that they're drying up the paper in order to basically suppress the yields on it and keep it from going crazy, then we should see this continue to drop. And again, the U.S. stock market will benefit from all of that.
And the SVB crisis, again, another big spike. Now, why is that move index so important? It's because it governs collateral in the system.
Yeah, so real quickly. So Albert says, okay, understood. Thanks for the explanation. Coming to think of it, if it was that easy, everyone would be doing it all the time, right? It's not. It's very complicated systems. There's a lot of underlying debt and leveraging of debt that occurs, like the shadow monetary base being $100 trillion, roughly three times the size of the U.S. federal deficit. There's just so much hidden shit behind the scenes in derivative markets. If you see I'll have to show some visual representation. I think it was Visual Market Capitalist, Visual Capitalist, something like that. One of these sites had a really good representation of like all these different forms of wealth that are stored, including debt, which is, again, the government printing bonds that are considered wealth and assets. It's funny how fiat works. It's like we issue debt that's really a liability, but we also count it as an asset because we're the fucking world reserve currencies or whatever. And that's just how governments work. But there's a lot of stuff that happens behind the scenes that could blow up, and so it has to just be constantly monitored. It's not an easy like, oh hey, we fixed it. Dr. Gonzo, war also requires a lot of liquidity, and the central banks are always happy to oblige, like a dealer to a junkie. They're the winners. Yes. That's why war has been so prevalent. That's why people, and I used to get angry about this because I'd be like, the industrial military complex, and it's not like there's this, I don't like to think of like conspiracies of these larger entities that are trying to control, but really it's just, it goes back to Charlie Munger saying, "You show me the incentive, and I'll show you the outcome." If the incentive is to create war to fix problems, and it's easier to do that than to actually reduce your budget because you don't want to tell everybody in your local states, "Oh, hey, we reduced the amount that we're paying for this. We reduced the amount of government for this thing. It's going to hurt a little bit." And there's no incentive to do the hard work, right? So you take the easy way out, and the easy way out ends up being war. Isn't that insanity? But his history tells us that's true.
And collateral, or put it another way, let me step back. Most lending in financial markets since 2008 has basically been collateralized. Okay, so in other words, if you want to borrow from a bank or credit provider, you post a bond, or it's a bit like a mortgage. If you like a conventional mortgage, your lending on a house is basically collateralized against the value of the property. And again, if you're lending in financial markets, it's collateralized against the value of a government bond. And normally, pristine collateral is being deemed to be U.S. government bond or a German Bund or whatever. Those are the top.
Yeah. That's a change from like LIBOR to SOFR as well, right? Like we've gone from an unsecured lending standard to a secured lending standard.
Exactly.
Yeah.
Everything is now secured. And so the move index is critical because if you're lending, your credit provider, you're lending against collateral, the haircut you give on the collateral, in other words, the discount, how much you're going to discount it by, depends on the volatility in the market. So if you have a very volatile bond market, you're going to have a bigger haircut, which you snip off the value of the bond. And so this is a direct multiplier that then will affect how much collateral can be borrowed against in the system. And if you look at the next slide, what it shows is the change in the collateral multiplier, the earlier chart, which is basically the orange line. So this is the annual change in the size of the collateral multiplier. And the black line is the move index inverted. So you can see a really close correlation here between changes in the move index and changes in the collateral multiplier. So if the move index comes down, the collateral multiplier will expand and there'll be more global liquidity in the system. In other words, you can get more leverage in a low volatile environment. Now, how does
And again, he's going to explain why, but he's saying essentially what I said, that if the move index goes down, we're going to see global liquidity multiplier or going in the other direction.
that answer your question about the Treasury buybacks? Because I think what Treasury buybacks are all about fundamentally is getting volatility down in the bond markets. They're basically shifting the traditionally.
This is when the government buys their own treasuries. Again, it's just such a fucking Ponzi scheme, all of it. They literally they issue debt so that they can fund existing liabilities, pay interest on debt, all the stuff that you have to run a government. But then at the same time, they can buy back their own debt while issuing more. And all this is just basically controlling the yield so it doesn't run away, and so that we don't have problems with sovereign debt crises and all this other bullshit. And I don't understand how some really smart people can't understand this concept and of how much control the government actually has over these levers. There's a lot of people that don't even seem to go this far, and I don't understand it because the government is much more, and especially Bitcoiners can be this way too, but the government is much more powerful than people understand, and the U.S. dollar is not going to die in the near future. There's just too many more levers that they can pull.
Off-the-run bonds, in other words, bonds that are seasoned, that are out there in the market, are less liquid than on-the-run bonds, which are newly issued bonds. And so newly issued bonds are more liquid, are less volatile. And so if you start to do treasury buybacks, you're implicitly, or maybe explicitly, in fact, actually reducing volatility in the market. And if the move index comes down back to its normal levels of around 70, and that's a long way to fall from where we are now, but if it comes back, which I think the Treasury is trying to do, it's trying to deepen the market, make it more liquid, you'll get volatility coming back, and that will be positive for global liquidity and the collateral multiplier.
Yeah, interesting. And I guess there's two ways they could do those treasury buybacks. Like they could issue T-bills and then buy off the red long ends. But I don't know if you've looked into this, I haven't either. But is there also a plan for them to say issue long end and then just buy back off the runs at the same tenor? Or are they mostly looking at like different durations in terms of issuance versus what they're buying?
It was always suggested when treasury buybacks were first mooted that it would be duration neutral. Okay?
Right.
I don't know if that has actually been the case. I rather suspect that, as you say, they've been using bills. So I think that there has been some duration effect in there. But in terms of the policy, I mean, these are. I mean, in the context of the bond market, these are in billions of dollars, but they're not in trillions. I mean, we're talking relatively small amounts, but that still means that they can have an effect on the market.
Just to finish up here, I want to shift a little bit to price action. When you mentioned this idea of tips actually being somewhat artificially higher than what we perceive, the first thing I thought about is real rates and looking at the price action over the last 12 months of gold and Bitcoin, because traditionally there's been a high correlation between when real rates come lower, gold definitely traditionally appreciates. But we've seen that correlation break down. So when you look at this and look at like the actual true break-even inflation, does that fix the calculation of real rates where suddenly they're actually lower than we expect, and that's why we've seen these hard assets perform so well?
Yeah, that's a very good point. I mean, I think that could be the case. I mean, I think it's all part and parcel of the same fact. Is that historically, if you look at what drives gold, real interest rates, I mean, have clearly been an important factor historically, but they tend to move the cycle more. Gold tends to move very much with a trend in monetary inflation, and that's how I think you ought to read it. So I think trying to fine tune or trade gold is kind of difficult. I would be much more, looking closely at the trend in monetary inflation, and that's how I see it. And I think the break, which actually probably corresponds, as you rightly point out, to this event, the break between gold and real interest rates was really when monetary inflation started to accelerate. That trend became established, and that was about two and a bit years ago. So I think that was where you saw the break. But I think it does, as you rightly point out, correspond to this too.
It's been a really great conversation, Michael. Just want to wrap up with your final thoughts. Sounds like you're constructive on gold and Bitcoin for the next year or so.
I've got some thoughts about gold and Bitcoin that I want to talk to you right after this.
Bonds sort of just chop around, nothing too crazy. Any final thoughts on equities and any other sector you're looking at?
Yeah, I think equities should do decently. I think there's a strong case to rotate maybe out of the US into international markets. It may be worth.
That might be true. I actually think there's a strong case for, again, small caps in the U.S. market. There could be international markets that benefit too. I don't think China will be one of them. But again, people can be crazy and irrational for long periods of time. So they might be like, oh, hey, ignore all the bad stuff happening in China. Ignore all the capital flight. Ignore the fact that their demographic cliff is worse than in every other place. Ignore all these things and invest in it, maybe. But I think the benefactors are probably going to be like Central and South America and India and maybe other parts of the South China Sea where they're getting the business from China as companies flee. So some of those markets could benefit, but I actually still think U.S. large caps will start to slow down because they're so overinflated right now. So like the Metas and all these things. But I do think companies that haven't done as well, like Tesla, and I also think the small caps that have suffered under the Russell for years and years, because especially after higher interest rates started to kick off from the Fed back in 2021, late 2022, beginning of 2023. I think that you're going to see, because they were already struggling before that, but you're going to see that those will have an outsized return like Tom Lee talks about. But let's continue here.
Looking at emerging markets, finally, they do well when the dollar is weak. They do well when commodity prices are strong. What drives commodity prices is principally the momentum or tempo of the Chinese economy. And what drives the Chinese economy is the People's Bank of China. Now, if we're correct in this thesis and the move down in the dollar is giving a window for the PBOC to ease, then you're going to get commodity prices lifting off following a Chinese easing. And I'd look at that pretty closely. We posted a chart a few times over the last few months on our Twitter feed, which is at CrossBorder Cap, which looks at the relationship between PBOC liquidity injections and the price of iron ore. And the correlation is remarkably close. So if you get China easing, commodity prices will definitively move higher. But I think we've got to see that yet.
Yeah, I don't know if I totally agree with that happening, but we'll see.
July was a very big month for liquidity inflows by the PBOC, even taking into account seasonal effects. It was big. August has been a little bit lackluster, I've got to admit, but I mean, a couple of weeks is difficult to establish a trend. So I'd be watching that pretty closely. Ultimately, the PBOC in China drives the world economy, and the Federal Reserve drives financial markets. And I think that's the way to think about that bifurcated effect. I think in terms of equities, I mean, my view would be that equities have probably had something like 2/3 of their gains, ultimate gains this cycle. That would be fairly normal given that, the length of the cycle. You always get, strong surge in markets at the beginning of a cyclical upturn.
And when he's talking about cycle, I think he's talking to the 5 to 6 year debt refinancing cycle that he talked about earlier in the conversation. He's not talking about the standard, 8, 9, 10 year cycle in markets. So, and if he's right here, then he's saying we've got another year and a half of upside potential before we see liquidity drop. So, and that would be roughly a third of that 6 year cycle.
Bull markets, remember, frequently climb a wall of worry. This one's been no different. But the distortions are because bond signals have been awry because of what the Treasury has been doing in terms of this yield suppression. So, otherwise, everything looks on track as far as I can see. You're looking at a cycle, a liquidity cycle expanding. The yield curve is inflecting upwards just about the time that we would expect. The real economy should be bottoming out in coming months. And you're seeing rotation in the stock markets pretty much as you might expect. You're getting an initial move in technology. That is spreading out into big financials and deeper cyclicals. They're beginning to progressively move. The rally is broadening. But a lot of the big gains have already been got, but you could still see fairly decent gains, maybe of the order of 10-15% over the next 12 months. But I'd watch out, because the closer we get to the end of 2025, the more chance there is of a major reversal.
Yeah, I 100% agree with all that. The only difference I think I have is the fact that he's talking about foreign markets being a better place for investment, and he's not really talking about small caps. And small caps will benefit from lower interest rates because, again, they're companies that potentially got slammed with higher interest rate debt loads, and they need to survive, some of them, the ability to be able to refinance at lower rates, and or maybe they can start doing capex and start expanding if they think that conditions are going to be better, so they can benefit from the stock market and the real economy doing better, and rates coming down at the same time. And I don't know that he's really touching upon this, but I do believe that to be very true. A lot of really interesting stuff in this conversation, though. I wanted to touch on something real quick before he finishes up. I wanted to look at gold again. What I find kind of fascinating is what he's talking about with gold. I've just been thinking about this, and gold has been outperforming Bitcoin over the short term, right? But if you think about it, it's the more, let's say it's the big cap, it's the large cap, right? Like I've been around for 2,000 years, and it has done really, really well. And what a gold bug will tell you, like a Peter Schiff type person, is that gold has rocketed up, let's see, almost 30%. Almost 30% just since February 2024, at a time where Bitcoin was not rising. Here's the argument I'd make towards that. Maybe gold is the large cap and it's the first mover advantage, even though Bitcoin is something that has a smaller cap and theoretically could move a lot more. Maybe people have been, especially we know this in East Asia, they've been running towards gold as a safe haven, especially in China, and so they've been driving up the price of this. Well, maybe that's just first mover advantage, and this is just a prelude of what we're going to see in Bitcoin here in the very near future because of global liquidity continuing to expand. So I think that very possibly it could be what's happening. Again, we haven't seen the 27% increase in Bitcoin in a while here. It hasn't done much of anything, but I do believe that that's coming. And that's an argument I wanted to make sure that I made, is that we could be seeing a major pump here. And again, we did have something, and it's about the same time. But again, what's happened, and actually, yeah, I should say this. Let's just look at this real quick. So around the same time, let's say January from the low here to the high, we actually saw Bitcoin grossly outperform gold. So I correct myself. It actually, and gold got a 30% return. This thing got 3x. The problem is gold right now is just slowly trickling higher, whereas Bitcoin has been trading sideways, right? And so even if you look at that same time frame, you can see that roughly Bitcoin has still almost, 80% outperformance, even with this drop here versus what we had from gold. So it's still outperforming. It's still showing first mover advantage because, again, by March, Bitcoin had moved off of increased liquidity or whatever drove it. Whereas gold took a lot longer than that. So gold started around the same time in January, and it's just recently here been starting to break out and find its gains. So again, these are kind of running in tandem with each other, but you can see where the multiplier is, and it's definitely with Bitcoin. But again, I think there's a lot of things that have been talked about here that we need to explore further and we need to talk about. But I just want you guys to understand what he said here about how much control the federal government, that the Treasury and the federal government have right now in regard to levers that can be pulled and pushed to both control rates on the high end, the 20, 30-year contracts, to keep them from going out of control in order to push bond prices, bond volatility down, while doing things that help increase liquidity, all while the Fed could still be drawing down their balance sheet and say, we're tightening, and the rate could be stronger than what the current rate of inflation is, but we're actually still expanding monetary supply and stimulating the economy. And if you just look at this haphazardly, at its face value, you're going to be like Game of Trades and some of these other guys that just doom and gloom everything and talk about the end of the world happening in the next 30 days, like they've been saying for the last several years. And that 7x I got in 2023, you wouldn't have got. if you listen to these people. So I do think that this is the right path forward. I think he's a little overly optimistic about China. And I think, again, I do think international markets, especially in, economies that are starting to surge and starting to build up like India and parts of Central and South America will benefit as well. But I do believe that small caps will, whereas he's not really talking to that. I think that's kind of the Tom Lee approach in regard to this. I hope you guys got value out of this. I definitely want to do more stuff like this in the future. I saw that Michael Howell was out there. He very rarely gives you a clear update on almost all of the metrics that he follows because, again, this is a paid-for service that he has a Substack for that he charges. I think I pay $80 a month or something for it. And so I will try and give you more updates in the future. I don't want to expose too much of his work from his paid service. So the fact that he had this public, I wanted to both support him and then at the same time talk to just all these great metrics that I've been talking about and I've been telling you guys I wanted to show you. But I think this is fascinating. I hope you guys got a lot out of it. And again, if you guys could smash the likes, make sure you hit the alert notifications, just things for timely responses. Otherwise, I will see you. I'll probably be firing up another one. I might do a political video just to get that out of the way for 30 minutes or something, giving updates on it and how things are sitting on polls and all that kind of stuff. Outside of that, though, if I don't do that, I will see you guys at 3 p.m. for the market recap with a special focus on NVIDIA earnings today because they're going to be monumental for the direction of where we're headed over the short term. So I think it's going to be really great stuff. Silas, hello. NVIDIA is like the new Apple, which people used to treat earnings pivotal 12 years ago. That's so true. That's so true. If Apple was doing well, the economy was doing well, irregardless of the wall of worry. That is such a great statement. I agree with that 100%. Send a prayer for CLSK. Is it down? Is it down? It's probably down, right? Down 7%. Shit, I wonder what the options look like. I might have to buy some of these. All right, I got to go. We got some buying to do. Love you guys, though, and I hope you gain value out of this. I hope, if nothing else, this maybe gets it to where you feel a little more confident about what the path forward might be. And if we have a good earnings today from NVIDIA, you'll feel even more confident in the fact that you know things that other people don't. So that was the goal. Again, talk to you guys later. And I think I'm going to skip the outro video, so we're just going to hang up. All right. Peace, guys. You have